For as long as most of us have been investing, buying the S&P 500, through an ETF like SPY, was basically investing 101. It was your simple one-stop shop for a piece of the entire US economy. Easy, right? Well, it's 2026, and I'm here to tell you that the game has completely changed. The S&P 500 just isn't what it used to be. So today, we're going to peel back the layers and figure out what you're actually buying when you hit that button for SPY. So let's just kick things off with a number that might honestly shock you, 1.24%. What is that? Well, that's the dividend yield on the S&P 500 right now. And look, that isn't just a little low. That is a generational low. We're talking about a yield so thin, we've only seen it one other time in the last 50 years, at the absolute peak of the dot-com bubble. For an index people have historically relied on for income, this is a massive, massive change.
Now, I know what you're probably thinking, but wait a minute, the market's on fire, and you're absolutely right. On the surface, everything looks fantastic. The index is smashing all-time highs, you check your portfolio and see green, and it just feels like the party is in full swing. And yeah, that headline performance has been amazing. But the real question is, what's actually going on underneath? What's really driving this thing?
Which brings us to the most important question of all. When you buy a share of SPY, you probably think you're getting a nice, diversified basket of 500 different companies, right? A true snapshot of the American economy. But is that still what's in the box? Let's pop the hood and take a look. Okay, let's get into the engine room and see what the modern S&P 500 is actually made of. Whoa. Okay, this chart pretty much tells the whole story right here. Just 10 companies now make up a staggering 38% of the entire index's value. Just let that sink in for a second. The fate of your supposedly diversified 500 stock fund is now massively influenced by what happens to just 10 stocks. The other 493 companies, well, they're kind of just along for the ride. And I bet you can guess who these 10 companies are. Yep, it's the usual suspects. We're talking about the titans of tech: Nvidia, Apple, Microsoft, Amazon, the whole crew. This is not your grandfather's S&P 500, filled with industrial and energy giants anymore. No way. This is, for all intents and purposes, the big tech index now. Here's a pretty good way to think about it. The S&P 500 used to be like a well-balanced sports team, with solid, dependable players at every position. But today, it's more like a team that has 3 or 4 superstar quarterbacks on the field at the same time. When they're on fire, the whole team soars. It's unstoppable. But what happens if just 1 or 2 of those superstars has a bad game? The whole team is at risk. And that, right there, is concentration risk in a nutshell. Now, this intense focus on a handful of tech companies has a direct consequence, a kind of hidden cost. And it brings us right back to that tiny number we started with. Let's talk about the vanishing dividend. Yeah, this really puts the whole transformation into perspective. Historically, the index was led by these workhorse sectors like industrials and energy, companies that were reliable dividend payers, often kicking out around 3%. But today, it's all tech. And what's the one thing we know about high-growth tech companies? They'd much rather reinvest every dollar into growth than pay it out to you, the shareholder. So the entire character of the index has shifted from diversified value to concentrated growth. So what does this actually mean for someone who needs to live off the income from their portfolio? Well, check this out. At today's 1.24% yield, you would need to invest over $800,000 just to generate $10,000 a year in dividends. That is a staggering amount of capital. It just goes to show you how much the S&P 500's role as an income engine has completely faded. So this new reality, as you can probably guess, has created a massive divide in how people see the market. You've got 2 completely opposite stories being told. So let's break down the great debate, the bull case versus the bear case. Okay, first, the bull case. It's powerful, it's compelling, and it all comes down to 2 letters, AI. The argument from the bulls is that this concentration isn't a bug, it's a feature. They believe these tech giants are leading a revolution that will change the world, and that the profit potential from AI is so immense that it completely justifies their dominance and, yes, their high stock prices. But then you have the bear case. The bears look at all that future growth and say, yeah, but what's the price? Right now, the S&P 500's price-to-earnings ratio is hovering around 27. That is historically very, very expensive. The bears argue that this high price leaves absolutely no room for error. If that explosive AI growth doesn't happen exactly as planned, well, stock prices could be really vulnerable. And here's where things get really fascinating. The stock market seems to be pricing in a perfect best-case scenario, but the bond market, what many call the smart money, is telling a completely different story. Bond investors seem to be a lot more worried about things like inflation and risk in the economy. And whenever you see these two major markets disagreeing so strongly, it's usually a good idea to pay close attention.
And there's one last little point for the bears, and this one is specific to SPY itself. See, while SPY is the oldest and most traded S&P 500 ETF, it's also the most expensive of the big three. It has an expense ratio of 0.09%. Its biggest competitors are down at 0.03%. That means you're paying 3 times as much in fees for basically the exact same investment. And over the long run, trust me, that difference really adds up.
All right, so we've looked at the concentration, the low yield, and the arguments from both the bulls and the bears. Let's try to put all this together and figure out what this new reality actually means for your investment strategy. First things first, we have to update our mental definition. Buying the S&P 500 today is no longer a simple, diversified bet on the whole U.S. economy. What it is now, really, is a concentrated, technology-driven, low-yield growth vehicle. Just recognizing this fundamental shift in its identity is the most important step you can take. So, what are the big takeaways from all this? Number 1, you have to know that when you buy SPY, you are making a very concentrated bet on the future of big tech. Number 2, if you need income from your portfolio, you are probably going to have to look somewhere else. And number 3, just be aware that valuations are high and there are some potential warning signs coming from other corners of the market. And all of that leaves us with one final and really the most important question. The S&P 500 itself has fundamentally changed. It's a completely different animal than it was 10 or 20 years ago. The only question now is, should your strategy for investing in it change too?